$2,800, if gold is statutorily $2,800, nobody knows. The market does not know who owns exactly, how many times over, how many times it's hypothecated and rehypothecated, what is the encumbrance on the gold in Fort Knox, who exactly owns it with how many claims. The market does not know. The market doesn't even know how much gold is there, which is why a gold audit is being discussed, because the market really does not know. So if the Fed or the Treasury or whoever it is saying that gold that you cannot get, that we do not know how much it is encumbered and how many times or how many owners that gold represents, that gold is worth $2,800 an ounce. How much is gold in your hand going to be worth? It's going to be worth much, much more.
In today's news recap, Morgan Stanley says this key factor pushing gold to record highs is now the single biggest risk. Morgan Stanley said the main driver of gold's epic bull run since 2022 is central bank buying, but this could reverse on one risk factor. Gold's record-thumping bull run could be about to reverse if U.S. President Trump forces Ukraine and Russia into a peace deal that heals geopolitical divisions and caps surging demand for the precious metal from major central banks. That's the view of Morgan Stanley's strategists in a February 14th research note that said an end to the Ukraine war is the #1 downside risk to gold, which could send it 17% lower to $2,400 an ounce in a bear case scenario. Gold is up more than 50% since the Ukraine war escalated in 2022, but lost 1.5% on February 14th to $2,880 an ounce on news reports. Presidents Trump and Putin spoke late last week about the conflict. Morgan Stanley said fast-changing geopolitics make it difficult to explain the magnitude of gold price moves using traditional approaches. However, its base case forecast is that gold hovers around $2,850 an ounce in the July quarter, with potential for U.S. trade wars to push it over $3,000 an ounce in the short term. The bank's bear case of $2,400 per ounce revolves around the thesis that major central banks across the emerging world in particular will slow their purchases of the precious metal if they believe the risk of sustained conflict between the U.S. alliance and Russia eases. In the final quarter of 2024, central bank purchases jumped 54% on the corresponding quarter in 2023, as other worries around U.S. fiscal deficits, money printing, and debt encourage nations such as China, India, Poland, Brazil, and Turkey to seek alternatives to U.S. dollar exposure. The strategists also said that real U.S. yields, measured as the yield on 10-year treasuries minus inflation rates, had eased since January in a move that should support gold prices. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Dollar revaluation. I'll call it gold revaluation because that's how people refer to it. Gold revaluation is not a new thing. It's been happening throughout history. It happens again and again. It's a way to erase the inflation. And by erasing the inflation, you erase the purchasing power of dollars that go with it. This is what happened to consumer prices the last time gold was revalued, from $21 to $35 from 1933 to 1934. So this is the Great Depression. Consumer prices were falling month after month after month. They were going down 9% year over year, around even as high as 10 or 11, 12% year over year. And here is the gold revaluation in April 1933. Prices were still going down around 9, 10% a year. And from there, consumer prices started to rise, and they rose and rose and rose until we get to 1934. This was the final revaluation in somewhere in early 1934. I forgot the month exactly, but we hit, it looks to be around a 5-6% a year in the CPI. So we had massive consumer price inflation as gold was revalued. So we can expect consumer prices in dollar terms to go much, much, much higher. Obviously, in gold terms, they will go down because gold was revalued 66% higher, excuse me, from 21 to 35. And this revaluation will be much more extreme. If we're talking anywhere near 2,800, it's several orders of magnitude more extreme than that. So 42 to 2,800, I don't know. It's a big number. So what happens to gold equities, miners, streamers, all those stocks that have been dead for so long? Well, here we have a chart from Gold Charts R Us, and we can see here relative to the Dow, gold is this line over here, and it goes up in the revaluation in April 1933, and finally up to $35 in the middle of 1934. I think it was June 1934. What was happening here? Well, the Dow, we saw that we hit bottom in 1932. We hit another close to a bottom here in 1933. And the gold revaluation, rumors of gold revaluation started over here. The Dow started higher. And on the gold revaluation, we were already, it was like a sell the news, buy the rumor, sell the fact kind of thing. And then stocks, at least the Dow Jones, meandered around this level until 1935. And it didn't start climbing until the revaluation was complete. But relative to that, we have Homestake Mining here in the blue, which is the main gold miner back then. And this stock really went insane once the gold revaluation started in 1933, and that's when it really took off. So as stocks meandered back and forth, and remember, another thing to consider here is that the Dow was falling and falling and falling because this was a deflationary depression and prices were falling, consumer prices were falling as well. But now we can print as much money, the Fed can print as much money as it wants. So what we're talking about here is even if the stock indices like the Dow and the S&P 500 are much higher now than they are relative to the top here, it means that consumer prices are going to go a lot higher, a lot faster because we're in an inflationary system, whereas this was still a deflationary system because it was still some vestige of a gold standard. So the point I'm making here is that stocks are not going to benefit much relatively. It's the gold stocks that are going to go crazy. You can see here, this is exactly what happened in the 1930s. Let's go to the next chart. Now we're talking.
In today's news recap, Chinese banks launch gold repurchase programs amid plunging prices. Several Chinese banks have started gold repurchase programs amid plummeting prices of the precious metal and increased liquidation demand from investors. This month, nearly 10 banks, including the Agricultural Bank of China, Industrial and Commercial Bank of China, China Construction Bank, Postal Savings Bank, and Ping An Bank, have launched or promoted gold repurchase businesses based on Yikai's incomplete statistics. Some investors told Yikai that banks informed them they could sell their gold products to designated bank outlets, but appointments need to be made online with at least a week's notice. Gold prices have been volatile this year after rising for 7 straight weeks and hitting a record high. Spot gold and COMEX gold futures both fell below the $2,900 per ounce mark last week. On February 14, COMEX gold futures dropped 1.76%, the biggest one-day decline since the latest rally, and spot gold in London fell by 1.66%. The industry is divided on the trend. Some institutions forecast large-scale price fluctuations to come, while others believe that the bull market of the safe haven asset will continue. A staff member of a large state-owned bank in Shenzhen told Yikai that investors need to book online to resell gold to the lender. Appointments have so far been scheduled until the end of March, but the bank will inform its customers if the situation changes. Lenders could use some more stock since some banks have sold out gold bars during the market rally. For example, ICBC's Ruyi gold bars were out of stock as of February 15, and at present, the Zhumeng China gold bar products in 20 grams and 100 grams are sold out. However, investors can still buy 50-gram and 200-gram products. Before we show you more clips, smash the subscribe button and check out our huge discount on NordVPN, the fastest and most reliable VPN on the market. This VPN service is a perfect fit for smart stackers who want their privacy protected and don't want their data compromised by prying eyes. For less than the price of a cup of coffee, secure your internet access and get 3 free months with our promo. Believe me, the only problem you'll ever have is that you didn't get it 6 months ago. Let's get back into the episode.
Talking about gold being revalued, or really the dollar being revalued to $2,800 an ounce. That is nowhere near enough to clear the market. If everyone wants gold at 2,800, there will not be enough gold relative to the amount of dollars that exist. The price that would be needed to be able to convert just the monetary base are the dollars that are directly in control of the Fed. M2 are the dollars that are based on the monetary base that banks can lend on top of. So deposits in your checking account are mostly M2, and the monetary base is what the M2, your bank deposits, are based on. A gold price to cover the entire monetary base would have to be $21,340. That's the amount of gold in Fort Knox, supposedly. That's the monetary base divided by the amount of gold supposedly in Fort Knox. You get a price of $21,340. If you want to cover the entire M2, that means if there is a situation where on a revaluation, everyone with every dollar in their account in every bank in the United States decides they want to convert all their dollars into gold, gold would need to be $82,706 an ounce in order to cover all of those M2 deposits. And we're just talking about $2,800. So $2,800 would not be a market price. It is not clearable. But what would happen? This, my friends, is what would happen minimally. On a revaluation, $2,800, the minimum market price for gold would very quickly, probably maybe not overnight, it would take a few weeks, maybe a month or two, would minimally go to 17,000. Why is that? Well, if we're to take the bear market bottom price of gold from February 2001, which is a low of $256, and that was as gold was still statutorily $42.22. The ratio of 256 to 42, you'd have to multiply 2,800, and you'd get, by that ratio, about $17,300. Let's just say seven. If we take the bear market bottom price for gold in 2001, February 2001, at $256, or I think it was 252, whatever it was, then you multiply by that factor, 42 to 252, and you get 17,000. And that's assuming maximum faith possible in the current monetary system at a $2,800 statutory gold price. I believe it will go much higher than that. But the most important thing to understand is that the dollar number for the gold price doesn't really matter. Once there is a revaluation, all of the purchasing power that exists in the entire dollar market cap that exists in the world gets transferred into gold at that rate. So whatever the dollar amount will be, it will be a massive shift in purchasing power from dollar holders to gold holders. We'll see the prices of everything fall precipitously in gold terms overnight as the revaluation happens, and they will continue to plummet in the weeks ahead. And we'll see that in a rising gold price in dollar terms, but we'll see that mostly in a plummeting price for everything in gold terms.
If you resonate with Rafi Farber's perspective on the looming collapse of the US dollar and the critical role of stacking gold and silver as a hedge against economic uncertainty, we'd love to hear your thoughts. Are you preparing for what's ahead by stacking? And more importantly, are you bullish on gold and silver for 2025? Let us know in the comments below. Your insights could inspire others in the community. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.